Let's see, Michael asking about the Greeks.
So the Greeks are like the gauges on your car. You obviously, depending on, that's a great question, but it's very hard to answer because there are so many ways to choose Greeks for depending on what strategy you're using, right? So I want you to just think of Greeks as if you're driving along the road. They don't necessarily control your car, but they tell you what to do. And that's how the Greeks work. So delta tells you obviously the price movement based on a dollar move in the stock price. It's also been kind of a rough probability gauge. Theta is obviously time to day. So you know how much money you're losing every day just based on holding that option. That's a very important gauge to know. And Vega tells you percentage volatility. So a 1% move in volatility, it shows you the dollar move in the underlying option. These are all things that you have to be aware of, and you have to know where they're at in order to pick the right strategy.
Okay. I want to go back on something you had mentioned before about debit spread. If we're buying, let's just say we're buying a straight up call, which I think most people are familiar with doing, where if it's going up, they're buying a call. If it's going down, they're buying a put. If let's just say for argument's sake, that call costs $500, just for argument's sake. So the reason we're selling the out of money call is to bring that cost down from, let's say, 500 to 200. We're capping the upside, but it's costing us less to get into the position. Is that correct?
That's exactly it. So what you're essentially doing is you're going from 500. Let's say you sell an out of the money call at a target that you don't think that individual stock is going to reach. You obviously don't want to pick something too close because then you're leaving money on the table. So you have to pick, and that's where delta comes in. You look at delta, then it's like a probability measure. So you can look at the chart, come up with a target, and then figure out what that number is, what that strike price might be, and then see what that delta is, see what the market's telling you.
So the delta is the odds of it hitting the one you sell and the time.
Delta is it's a measure of money movement, but it also measures the rough probability of something expiring in the money.
That's what I meant.
So if something has a delta of 20, it has an 80% probability of expiring not in the money. It's not a probability of making money though. I don't want to make that mistake. It's a probability of just in the money.
Okay.
So basically you want something with a low delta then obviously, because you don't want to hit it. You want it to expire worthless. That's the whole point. And you just want to lower the cost of your trade.
So the reason I brought that up is, again, we have a lot of new members or new people on the call, is you think about the allocation of capital and how a lot of people try from the start to think about how much they could make versus how much can I allocate to that one position. So in other words, instead of buying a bunch of out of the money calls, spending $1,000, just as an example, if you know that spread has a high probability, we'll stick to probability as the key word here, and you like that one setup, but then you do that same setup 3 times. Now you're putting up $600. It's a limited upside, but you put together a good trade.
But it's a higher probability.
Higher probability, exactly. The point I'm trying to get across here is there's so many nuances that go into a profitable options trade as opposed to I just want to be a buyer or seller.
Yeah. No, as you gain more experience trading, you'll realize it's all about risk management and allocating capital appropriately. You know what I mean? And that's the key. If you have $1,000 to spend, I'd much rather spend it on at the money vertical spread, let's say, that has a high probability outcome as opposed to just going for the lotto ticket. Because again, if the lotto ticket comes in, yeah, I might make $3,000, but I only have maybe a 20% probability. To me, that just isn't worth it. I'd rather do something a little bit smarter than that. So I try to put together trades that make sense. And I would say 90% of what I do is usually more than one leg. I think it's maybe 10% of what I do is straight calls and puts. And it's usually an event. If I'm expecting a very big move in one direction or another, yeah, then maybe I'll just do a straight call or a straight put. I'll use a straight put just to hedge, for instance. Let's say I'm long a whole bunch of stuff and the market rolls over. I'll just buy SPY puts as a hedge.